So what we've now noticed is that within a certain expiry, because of that concept called skew, we have one bit of a problem, and that is that all options can have their own implied volatility. So let's take a look at an example. So here I have options on the Hang Seng coming up. So what do you see? You see this column over here called IVM, which is the implied volatility at mid-market. In the past it was quite convenient that I could calculate gamma theta, and I would buy options where gamma is cheap, and I would sell options where gamma is expensive. But the problem is that now, because of skew, all options with different strikes are more or less desirable than others. Lower strikes tend to be more expensive options. So what do I need to do? I need to have some kind of a logic, some kind of a rule that can still allow me to compare different options. And the process of making that rule is to take a look at the logic that we've seen up until now. And let's start at the following. In this chart, what it represents, you see all the blue and red lines. So on the horizontal axis, it's different strikes, and on the vertical axis, it's the implied volatility. So you notice that the blue line is slightly lower than the red line. So blue is the bid volatility on the bid price, and red is the implied volatility on the offer price. So what I'm doing in this chart, I'm looking at the market, just like this. I see a bid price. Actually, I don't see it here. So here I see a bid price 337, ask price of 349. Given the price of my index, I can translate that into implied volatility. So the implied volatility in the bid is expected to be slightly lower than the implied volatility at the offer. Agreed? So otherwise, let's do one example. Let's say the following. Share price in the Hang Seng is 28,000, 1 month to expiry, interest rate 1%, no dividends, and I know that implied volatility is 28. It's expensive, by the way. Let's make it for 20. And the Vega is 50. I also know that the call 28,000 is trading 370, bid at 380. So what do we know? We know mid price is 375. Agreed? The bid between bid and ask. So I know that applying a price of 375, I can get that out of my option pricing model if I enter volatility 20. Now I can calculate the actual bid in the market is 370. The actual offer in the market is 380. Given that I have a Vega of 50 and 375 would correspond to volatility 20, what is the implied volatility I would be paying if I buy the option at 370? And what is the implied volatility I would be receiving if I sell the option at 380? So can I have help of C13? Already had? Not in? Okay. A12? I think already done. B18, that sounds new. But not in? Okay. B14, and yeah, but you already had a turn, right?
Yeah.
Okay, do you feel lucky?
Maybe.
Okay, let's. Now, so it's relatively, what I'm trying to do, I know that one volatility point will make my option worth $50 more, right? So if volatility 20 is 375, then $5 lower at the bid price, what would be that volatility?
A tenth.
Exactly. So it's a tenth lower.
Yes.
So the bid volatility is actually 19.90, ask volatility 20.10. Agreed? At a mid price of 375, that's volatility 20. So the offer price is $5 higher. So on a Vega of 50, that's a tenth of a volatility point. Bid price is $5 lower. On a Vega of 50, that also is a tenth of a volatility point. So I can translate that market. First I take implied volatilities, and then I can calculate what's the implied of the bid and what's the implied of the ask. That's exactly what I'm doing in this chart. So the red line everywhere of a strike is the ask volatility, and the blue line is the bid volatility. And this is a typical volatility curve. So what you see, there is a bit of a pattern to it, but how can I match this curve? What I want to be doing, I want to make some kind of a function that I can, with as least parameters as possible, I can capture that whole volatility curve. So where do I start? What do I know? I have to start somewhere. So I start with my at the money options. So my curve should intersect, in this case it's the 100 strike, my curve should intersect or should be in line with the at the money volatility. That's where I start. I read from my screen. So what do you now notice? Actually, only this option is priced in line. All the downside options, I need a higher volatility. Here I need a lower volatility, and then it tweaks up again. Now let's add one thing that we know. We know, because of that skew, that we like small options better. In all my examples, I said the right side would be to own the 95 put and to be short the 105 call. Agreed? So apparently, because downside movement tends to be more aggressive, it is our preference to be long those downside puts. So that means that I want to shift, or I want to skew my line. So this is what I'm doing here, right? I now say lower strike prices should have a higher volatility. Higher strike prices should have a lower volatility. So I'm tilting my curve. That's the first step. But now we still notice that even though I have a range where I am correct, for all these options here I'm still too low. For these options I'm also too low. Also, if I have a linear curve, that means that at one point I will intersect the zero axis. And volatility can of course not go negative. So what I need to add some curvature. That also makes sense intuitively. If I look at the Hang Seng, let me just get all options out there. So if you look here, the 26,000 put, we now trade 28,000. So the thing trades over here like $1 bid at $2. So these are options with small amount of premium, hardly any Vega, so they're just sitting in a corner and most likely dying. So if I sell it, what can be my best result? Yeah, I make $1. So if I would sell this option every month I would make $1, but then 1 month, let's assume that we get some terrible, big downward movements on the very last day. Suppose that instead of trading at 28,000, drop, and this guy becomes at the money. An at the money option, in this case, has a value of about 160 points. So if we would have in this once in a while day that we have this big move down, that option could go from value 1 all the way to over 100. So if I would sell it every month, I would make a steady set of $1 per month, but once in a while I would be terribly blowing up, losing more than 100. So is that good risk reward? Most likely your risk manager or your trader yourself doesn't really like that exposure to. It's like picking nickels from the railroad track. So I would be a bit more hesitant to sell these little calls and puts. So how can I make certain I sell less of them? That's if I raise the price. That's what that curvature does. What I'm doing with curvature is that the far out of the money calls and the far out of the money puts I want to make a bit extra expensive. So instead of a linear curve, I'm going to curve them a bit. So it looks, again, it's in PowerPoint, it looks something like this. The problem with a curve, the definition of a curve in mathematics, where are you? The definition of a curve is something like this. A plus bx plus cx squared. And they become these nice parabolas. So the problem is, if I would do this with volatility, then I would have, on the outsides, end up with nearly infinite volatility. That can't be right. So, after adding curvature, you see that for the far out of the money call puts and the far out of the money calls, that curve gets too steep. So I just need to cut it off, that beyond a certain point I just draw a straight line. So what you now see, I had to give 8 inputs. At the money volatility, that degree of slope, the curvature to my upside, the curvature to my downside, the cutoff point, where do I go straight on the upside, the cutoff point on the downside. So apologies, 6 parameters. So I type in 6 parameters, I can cover the entire volatility curve. That would be great because now, if I have a logical curve, I can start seeing outliers. And if I can trade outliers against each other, that's where I can earn money. So first, let's build that curve. So the function of that curve should be, I input a strike and out comes a volatility. So the idea is that volatility of a strike is a function of that strike. But the problem with strikes, some stocks trade at 10, some stocks trade at 1,000. So strikes are not really the best input to compare. So what I'm going to do, I'm going to introduce a concept that I call moneyness. What is moneyness? Call it mon, is the log normal of the strike over the spot or over a certain reference. Why do I do this? Well, it gives convenient outcomes. Let's start, or let's... So if I would have all the diffs, so here I have the spot, I would look at all different strikes and all different volatilities. Because that's what a volatility curve is like. For different strikes, at today's share price, for different strikes, different volatilities. So one point is interesting. If I would have a strike price exactly equal the spot, then I would take the log normal over strike divided by spot. If strike equals the spot, then it would be the log normal of 1, which of course is 0. So a log of 1 is 0, so I know that my at the money give me a 0. What happens if I look on the left of my chart? Strikes that are smaller than my spot price, so out of the money puts. If I take the log normal of a number between 0 and 1, it becomes negative. So over here, I have negative moneyness. On the other hand, if I have strikes out of the money calls, so I look at a strike that's bigger than the spot, the log normal of a number above 1 is positive. So over here we have positive moneyness. So that moneyness is a great input. At the money, money plus 0, which is my middle, which makes sense. Out of the money calls, I deem positive moneyness. Out of the money puts, I deem negative moneyness. So now I can make a curve where the function is of the moneyness. So what am I going to do? So the volatility of a certain moneyness is, first thing I check at the money volatility, the fixed level. Then I would do plus a factor we call A, in this case slope, times the moneyness. So what do I want to achieve? I want to achieve that small downside options are more expensive than upside options. So I want to give options with negative moneyness a higher volatility, and options with positive moneyness a lower volatility. So what does the sign have to be of my slope? Ask a volunteer. C3. Yeah. So I know that I want options with a negative moneyness to have a higher volatility, and options with a positive moneyness have a lower volatility. So that number A, is that a positive or negative value? It must be negative. Because with a negative value times negative moneyness is a positive number. So downside options out of the money puts will have a higher volatility. And positive moneyness multiplied by a negative number is a negative adjustment. So out of the money calls, positive moneyness will have a lower volatility. The next part I need to take into account is that curvature plus B times moneyness square. What that curvature entailed is that all options that are out of the money, either far out of the money calls or far out of the money puts, should have a higher volatility. So that B, that number that we call the smile, should of course be a positive number. So this is the mainstay of my volatility curve. In the end I would have these cutoffs, I leave them out of the matter for now. The final step. Nee. Here we go. The final step, if you look at this picture, you see that to the downside, or let's go here. If I look at that after putting in the smile, or the slope, apologies, I need to add some smile to the downside, but for the upside, for the positive moneynesses, I need to put in quite a bit maybe, because that curve has to stop from hitting my bottom and actually start tilting upwards again. So do you agree that the smile that I apply, that curvature on the left side of the curve could be different from the curvature I apply on the right side of the curve? If that's the case, how can I fix that? Well, if this is my formula, if I am exactly at the money, my moneyness is 0. So therefore, if my moneyness is 0, this whole part of the curve is 0. I just end up with my at the money volatility. So I can use a different curve on the upside and on the downside and still have my volatility curve connect at the money volatility. So that's what I'm doing. So I can define with at the money volatility one slope number, a number for the down curve and the number for the up curve. I can already define a logical function of volatility. So what looks to be relatively gibberish strikes, I add my logic and now I have exactly covered that volatility curve. So now I have some kind of a theoretical, a theoretical base with which I can look. So now let's draw some pictures ourselves to see how does the process work. So let's say my volatility, I just have mid-market. So what am I plotting? On the horizontal axis, different strikes. On the vertical axis, volatility. So now if I want to draw a curve, I could say, okay, I'm just going to connect the dots. So now this is my volatility curve. It nicely connects all the dots. Do you think it's logical? Does it look nice? It looks ugly. If I would have, in this case, 12 volatility points and I would have 12 parameters, I can fit this curve like this. But why don't I try to make a smooth fit? Let's try it again. So I'm going to start here and I'm going to slowly, let's steadily. Something like this. So what we now notice, compared to my smooth curve, these options actually seem a bit expensive. This one seems cheap, and this one seems cheap. So what can I do? If I have a logical curve, I can start detecting outliers. Let's make a different example, but a bit neater curve. Suppose I have a nice volatility curve and I'm going to enter bid and ask prices of different strikes. So we start here, where are you? Yeah. This strike is in line, this strike is in line, this strike is kind of cheap. Okay, so the horizontal dot stripes, bid volatility, ask volatility. So you see that even though they seem to follow my curve a bit, there's a couple of outliers. Because what do I see? This option here, I can even pay the offer price and still it's below my line. I can hit the bid price, it's still below. Pay the offer price, hit the bid price. So here you can see, if I would look at this volatility, look at the market, I can buy one option cheap, this one here, sell this option expensive, buy this one cheap, sell this one option expensive. So I can now start pointing out with colors or other identity a trading opportunity. Compared to my logical curve, some options look a bit cheap, I buy them. Some options look a bit expensive, I sell them. Look at the beginning of the market maker. Your objective was to trade in and out as much as possible. but you want your portfolio to be relatively neutral. So when you're buying option, you want to sell them out somewhere. When you're selling option, you want to buy them back somewhere. So you want to be trading in and out so that your position remains limited. So in this case, as long as I see opportunities below the curve I can buy, and above the curve I can sell, if I keep on doing that, I make money. If my theoretical curve is right. But if I trade around my theoretical curve, I can still make money. Suppose my theoretical curve is wrong. Then I can buy an option below my wrong theoretical curve, but sell another one above my wrong theoretical curve. So I'm still doing an in and out trade with a much smaller exposure altogether. The only thing I need to know is that the market changes consistently. So let's take a look at one more example of a trading day. Bear with me 1 sec. Insert please. Pretorius? Hallo, Togo. Ik ben op dit moment aan het lesgeven in Taiwan. Kan ik jou later spreken? Oké. Ik ben hier op de Amsterdam. Kan ik jou morgen bellen of kan ik mailen? Ik ben hier vanavond nog. Oké, ik denk het wel morgen hoor, tenzij ik niet in mijn hotel terug ben. Ik stuur op moment dat ik in mijn hotel ben een WhatsApp, misschien het laat. Ik moet ook met onze Taiwanese team opstappen. Exact, ja, dat was ik ook. Ja. Dus weer later, bye. Okay, so let's start at a typical trading day, but now let's see what the opportunities are. So if we do a different color. Okay, so let's say the first opportunity is a price here. So my idea, okay, that the price of that option implied volatility, so therefore the option price is higher than my curve. So I'm going to sell this guy, agreed? And then I see an opportunity over here, so I'm going to sell that guy again. Then I see an opportunity over here, so I sell. Opportunity over here, so I sell. Opportunity over here. So I sell. So now I use my curve and I see 5 trades where I can trade at a higher price than my implied volatility. So I end up selling the option. But am I now doing, I would say, is it in and out trading or am I taking a position? In the end, the only opportunities I see is selling options. Which option can I buy back? I haven't seen an opportunity. So maybe instead of just doing one directional trade selling options, I must say maybe I need to adjust my volatility curve. So let's say I'm going to raise my volatility curve a bit. So this, I'm going to raise my volatility. And now it looks differently. Now this one should actually be a buy. This one should actually be a buy. But these guys remain sell. So it only works, my aim of buying and selling options using that theoretical implied volatility curve only works if I'm able to buy and sell at around the same time. So if I see buy and sell opportunities, that means I'm doing good. If I only see buy opportunities, most likely my curve is too high. If I only see sell opportunities, most likely my curve is too low. So what you saw, initially the green curve, I only saw sell opportunities. So I had to raise my volatility a bit. And what do I know? that actually two of the most marginal sell opportunities, the one in the middle here, should be buys. Why? Because I am selling the other ones at such better prices that comparingly I should buy these two in the middle. How can I make that comparison? That's if I update my volatility curve. So what's the job of a market maker? It's not that glamorous. Continuously updating that volatility curve so that my trading opportunities remain to be in and out. Not just selling options, that means my volatility is too low. Not just buying options, that means my volatility is too high. So I consistently trade with the market, adjust and continue. But I also need to look at other aspects that we discussed. So here's another volatility curve. And what happens now? I see all these opportunities to sell. And here I see all these opportunities to buy. So again, on first glance you say, well, it's good. I'm buying options as well as selling options. So that means overall I'm doing good. But is there a pattern? Am I selling and buying similar options? Now what I'm doing, I'm selling all these small negative moneyless options. I'm buying all the positive moneyless options. So I might want to adjust my volatility curve. I need to apply a more negative skew, a more negative slope. So my new curve should actually be a bit more like this. So you notice that what I'm doing effectively, I'm tilting the curve a bit. I'm making a more negative slope. The negative moneyless options get a bit more expensive. The positive moneyless options get a bit more cheap. And now you see that my curve, again, is much more through all these different opportunities. So the market apparently changes its mind with regards to, do I like upside or downside puts? The market is a bit more scared, wants to pay a bit higher volatility for these out-of-the-money puts. And as a result, I can do two things. I can sell as much as I want of the downside puts and buy upside calls, or I can adjust that skew. Finally, one more. So now the opportunity is I can buy deep out of the money calls, I sell at the money options, I buy deep out of the money puts. So again, at first glance, yeah, I'm buying, I'm selling, it's all across my curve, so it should be fine. But again, there's a bit of a pattern, because it's these far wings that I'm buying, and it's actually at the money that I'm selling. So maybe I'm paying too much for that smile, for these wide out-of-the-money calls and out-of-the-money puts. So again, I might want to adjust my volatility curve. So this becomes a bit lower, this becomes a bit higher, and this becomes a bit lower. So now I'm flattening the wings a bit. So to cut a long story short, the job of a market maker is to continuously look at all these implied volatilities, trade in and out as much as possible, and as soon as you're being pushed a bit into a position, you need to adjust your curve so you're able to trade out of it. Similar, remember in the beginning when we had that future script, doing H-share versus Hang Seng, or Euro stocks versus DAX. Same kind of thing, you adjust it against the position you held. So if I buy a lot of these options on the far wings, that means I need to adjust against me, making these far wings a bit cheaper. If I sell a lot of downside puts, buy a lot of upside calls, then I need to adjust against my position and make the slope a bit steeper. So I'm continuously adjusting that curve so that it still matches the market. And as long as it matches the market, I can pick up opportunities, buy stuff below my curve, sell stuff above my curve. As long as the trades occur randomly across my curve, I buy and sell, upside, downside, at the money, different maturities. As long as I keep on trading in and out, then all the money from the bid-ask spread is mine. But if I don't pay attention and I'm forced into a position that I'm only selling volatility, I'm only selling downside skew, then I still make first money on paper, but I'm being pushed into a position that I might not like. So the goal of a market maker is to continuously trade in and out, and he can only do that if you adjust that curve continuously against your position. So the final slide about that curvature, these numbers to put in. So what would be a good number for that slope? Because ideally, if I'm trading different options, or I have different maturities within the same instrument, I would like to be able to compare the different volatility curves. Because you can imagine that if my July curve looks like this, options expiring in July, and if my May curve looks like this, it's a bit odd that these lines are so incredibly different and they're crossing each other. So I would like to be able to compare these various curves. So the numbers in a way are important, and the first one, let's look at the following. Let's say the share price in the TAIEX is about 1,000. I have the call 10,000, volatility 16, and the call 10,100, volatility 15.5. That slope can now be expressed as the change in volatility for 1% difference in moneyness, or strike difference. So in this case, the slope is -0.5. A strike that is 1% higher, 100 points higher strike, is half a vol point lower. So the relationship for every percent higher strike, I'm looking at a 1% lower volatility. So that's an interpretation of that slope. That's our final strike. So here, if there's half a point difference between the 50 and the, there's 0.6 volatility difference between the 50 and the 60 strike, then that is about 4% strike difference. So for each percent strike difference, that is 0.15%. So this one would have a slope of -0.15. So this is it purely from the perspective of a market maker. So now you can say there's two market participants. The market maker who, abiding by his volatility curve, continuously adjusting, continuously trading in and out. He makes the market and he reaps the bid-ask spread. So that's one type of market participation. But You can also say, I'm gonna look within the market, and I'm gonna say, do I agree with these market volatilities? So the market maker has no opinion. Market maker continuously adjusts to the market. So he trades around market volatility, but he doesn't really have an opinion about them. As long as he can trade in and out, he'll make money. But what if you're not a market maker? What if you just stand on the outside, take a look, and the only thing you're seeing, am I actually agreeing with all these volatilities out there? So if you look at that, then you get towards the realm of volatility arbitrage. So we have a lot of tools available, a lot of relationships to compare different options, different maturities, and different moneyness, and to say maybe things are a bit out of whack. So there's 3 types of volatility arbitrage. I can look for risk-free arbitrage opportunities within an instrument, that is there free money? I can look for relationships between maturities or moneyness within one underlying. Or finally, I can look at relationship between different underlyings. First one, start relatively simple. Oh, it's difficult to see, right?